All right. Hello, everybody. We are about to get started. If you want to see how I am growing a $25,000 account into $1 million, and you are in exactly the right place, because that is exactly what I'm going to be talking about here today. People are still getting connected to this webinar, to our live stream, getting situated. So I just want to give that a couple more seconds for that to happen. We are live on Facebook, on LinkedIn, on YouTube, on Twitter. This is an exciting topic. Don't want anybody to miss out. So looks like we are looking good. So let's go ahead and dive in here today. All right. So again, welcome everyone. Thank you for joining me here today. In the next 30 minutes or so, I'm going to talk about my journey of growing a $25,000 account to $1 million. So that's my goal, to show you exactly how I am investing my own money. And if you stay until the end, you're going to learn how to copy me, even if you know little to nothing about investing. Does that sound good? Awesome. So who am I and why should you even care what I have to say? Well, my name is Eric Hagan, and 2023 marks 20 years that I've been helping people invest their life savings in the stock market. I am a fully licensed and fully regulated financial advisor. I abide by a set of fiduciary standards, and I always put the best interests of my clients first. If you Google broker check Eric Hagan, you can get all the details. Broker check is a tool that shows you any regulated financial advisor's employment history, certifications, licenses, as well as any violations. Today, I'm also a small business owner and president of the independent wealth management firm Capital Consulting Group here in the Twin Cities area. I've been awarded numerous top advisor awards, 5-star wealth manager awards. I've been featured in the Wall Street Journal and Forbes, Twin Cities Business Magazine, Minneapolis St. Paul Magazine. For that, I've been asked to share my experience with hundreds of other advisors from all across the country. I got into this business right out of college. It's all I've done ever since. I received my degree from Bethel College, now Bethel University in St. Paul, Minnesota. On a more personal side, I met my wife Kelly at Bethel, and now we live in the Twin Cities here with our 8 kids. Now, I'm very proud of my family, but I share this with you so that you know that I get it. I understand. I know that life is busy, and I know it's hard, if not impossible, to give your life savings the attention it deserves all on your own. If you are a busy professional, if you don't have the time, or if you would just rather spend your time doing something other than managing your life savings, then this message is for you. Now, as we get started, there are a few things that I learned over the past about 20 years that I want to share with you. And the first is that when investing, what is comfortable will rarely be profitable. Have you ever heard the saying, no pain, no gain? Well, that applies to investing as well. There are no guarantees when it comes to investing. The way that I invest means that I can see big swings in the value of my account. It goes up and it goes down. So if you are looking for more of a sure thing, what I'm going to talk about in the next few minutes is not for you. So that's number one. Number two, I've also learned that there is only one kind of investment advice that actually matters. And there are many places that you can get investment advice. You can get it from TV, from radio, from the newspaper, social media, of course, a lot of email newsletters out there. You can get it from family and friends. But there's one thing that all of these have in common, and that is that none of them take you and your unique situation into account. None of them know your financial situation and how their investment advice impacts your financial future. None of them are accountable to you. That is why the only investment advice that actually matters is the kind that is accountable to you. So that's number two. And then lastly, I've learned that if you don't know what your investments cost, you're probably paying too much. Most of the financial services industry is made up of products, and all the big firms are fighting hard to get you to buy them. Here's what I mean. Let's take a very popular investment product, mutual funds. Most people understand that there is a cost, something called an expense ratio, that the mutual fund company charges for its management of the fund. But there are other costs more below the surface that are very hard to determine and even harder to calculate. There's things like transaction costs, tax costs, cash drag, soft dollar costs, and all of these are in addition to any financial advisor fees, commissions, sales loads, and more. I have several resources that puts the total annual costs of many mutual funds to be between 3 and 4% per year. And that is before you add in the cost of a financial advisor. Think about this. If you have $100,000 invested in mutual funds, then your cost could run up to $3,000 to $4,000 or more every year. How much is that over the next 10 years? How about the next 20 years? Don't believe me? Google it. A simple Google search yielded results like this on the very first page. How mutual fund trading costs hurt your bottom line. The mutual fund fees that we don't talk about. Uncovering hidden costs of mutual fund investing. Shedding light on invisible costs. I've spent the past 20 years talking with individual investors, taking apart their portfolios, putting them back together. I have literally had thousands of conversations with investors over my career. And I can tell you that not a single person I've ever talked to about this knew these additional costs even existed. This means today you get to tap into all those conversations in just the next few minutes. Are you actually paying more than you think? If you don't know what you're paying, you might be. All right, so those are a few things that I've learned that I wanted to share with you today. Next, we're going to look at the things that you're going to learn today. Specifically, there are 3 things that I'm going to teach you. Number 1, I'm going to teach you how to avoid all the internal expenses of mutual funds and annuities, even those hidden ones, without paying a commission, load, sales charge, or hidden cost ever again. Then I'm going to teach you the weird, almost backwards investing secret for growing almost any kind of an account, whether you have an IRA, Roth IRA, individual jointly owned taxable accounts, maybe you have old 401ks that you forgot about out there, trust accounts, simple IRAs, SEP IRAs, lots of different types of accounts and more. And then number 3, I'm going to teach you the 3 essential ingredients required for all investment success. And if even one is missing, failure is guaranteed. All right, so let's start with number 1. Remember, investment products like mutual funds and annuities have internal expenses and costs that are hard to understand and hard to calculate and hard to truly know. Mutual funds, again, can cost 3% or more each year. I've seen annuities that can easily be well over 5% per year. And that's the first step that really makes what we're going to talk about here today different. I'm not going to show you the next mutual fund to own or any type of an annuity. This is not any kind of pooled investment like a REIT, limited partnership, business development company, or otherwise. It does not tie your money up. It does not have a surrender period. What we're going to talk about is not a product to buy from some big investment or insurance company trying to sell you something. Instead, we're going to get back to what the heart of investing in the stock market really is. And that is investing in individual companies, in individual stocks. When you own shares of individual stocks, there are no internal expenses, none. Investing in individual stocks have no internal expenses or costs. Now, to do this, I use a special type of an account that allows for unlimited trading for one flat fee. This means that I can buy, sell, trade as much as I want, and the cost is one flat fee. No commissions, loads, sales charges, etc. The single fee covers everything. Now, here at my firm, we call this Contour because it works for just about any kind of an account. And every account is separate and unique from the others. My account that I'm talking about today is a regular taxable account, but you can have IRAs, Roth IRAs, individual accounts like mine, joint accounts with a spouse maybe, trust accounts, simple IRAs, and more. So that's number 1, how to avoid all the internal expenses of mutual funds and annuities, even the hidden ones, without paying a commission, load, sales charge, or hidden cost ever again. Next, we're going to look at the weird, almost backwards investing secret. So what is this secret? This secret is to have a strategy. A strategy is a lot like a blueprint when you're building a new home. The blueprint tells you what materials to order to build the home and how much of each material is needed. An investment strategy tells you what to invest in, how much to invest in, and when to make a change. A strategy is a repeatable process that can be done over long periods of time. It means that what I invest my money in is not based on my gut feeling or what I think is going to do well. It allows us to remove the emotion from investing and replace it with discipline. So, again, when it comes to investing, a strategy helps you know what to invest in and when to make a change. Would you like to see what I mean? Great. So, today I'm investing in 30 individual stocks. And what I'm going to show you next is my strategy for picking those 30 stocks to be invested in. Did you know there are more than 6,000 companies, 6,000 stocks that you can invest in on the New York Stock Exchange and the NASDAQ? Now, some of these companies will be here and doing well many years from now. Some will be gone or fall out of favor much sooner. Because I am an investor and not a trader, what I want to do is identify those companies today who will be around and doing well for many years into the future. To do this, I want you to think of stocks or companies as being like a medieval castle. The same way that a moat protected castles, there are certain characteristics companies can have that protect their ability to be and remain profitable. The more a company can protect its ability to be and remain profitable, the more they have a long term, sustainable competitive advantage. I want to invest in companies with a wide economic moat around them. So to find companies with a wide economic moat around them, what we do is we go to Morningstar. Morningstar is the world's largest investment research firm for financial advisors. Currently, Morningstar has a team of over 100 analysts whose sole job it is to look at all those 6,000 companies and rank them all based on their moat. Some stocks have no moat, some have medium moat, and some have a wide moat. At last count, these analysts identified 311 companies as having a wide moat, meaning they determined these 311 stocks would have a sustainable competitive advantage for at least the next 20 years. Now, 311 stocks is far too many to try to invest in, so we need to filter these 311 companies down to a much more manageable amount of just 30. So the next thing that I did is I hired my own chief investment officer. His name is Tom. Tom has over 35 years in the investment business. You can see he has quite an impressive resume. A few things to point out: at his previous firm, he managed over $1.5 billion. Notable fact, he presented his proprietary research to the Federal Reserve Board's investment committee. Again, you can see he's got an impressive resume. What Tom does is he goes through that list of 311 wide economic moat stocks. And the first thing he looks for are those ones that are less expensive than the others. Not a lower share price, but less expensive. If you've ever heard the saying, buy low and sell high, this is what he's working to do. He does this by searching for those stocks that are trading at a discount. And he looks for those that are gaining momentum in the market. Have you ever heard the saying that a body in motion tends to stay in motion? Well, the idea here is similar, is in that a stock in motion tends to stay in motion. And after this rigorous filtering process is done, Tom is able to boil those 311 wide moat stocks down to just 30 individual companies. And these are the individual stocks, the individual companies that I've invested my own money in my own account. Now, over time, these stocks that I'm invested in can and will change. And that is because this is an ongoing process. This is not something that is done once and then I just sit on them. This process is reviewed on a regular basis. When companies that I own no longer meet this filtering process, they are sold and replaced with ones that do. So, does it work? Well, here's what I can say. Over the past 5 years, as of April 1st of 2023, earlier at the beginning of this month, the S&P 500, as represented by the S&P 500 ETF, which is an index that many people use to measure how the overall stock market is doing, that S&P 500 fund is up 73.3%. 3%. And over this exact same time frame, these 30 stocks that I'm in, these wide moat stocks, have gone up in value by 144.8%. This means that if you had put $10,000 in that S&P 500 ETF 5 years ago, you would have seen an increase of over $7,327. Might be surprising with everything going on this past year and COVID and all of that. However, if you had put the same $10,000 in the 30 wide moat stocks that I just described, you would have seen an increase of over 144%. And again, all this in just 5 short years. Now, if you want to know exactly which stocks these are, be sure to stick around until the end, and I'll explain how you can actually get a list of them. And remember, if you have an IRA, Roth IRA, simple IRA, old 401ks, or regular investment accounts, I'm also going to show you how you can copy me and invest in these stocks in your own account, even if you know little to nothing about investing. Now, moving on, I actually want to take this strategy one step further. And another important thing about this strategy is that sometimes the markets go through periods where it is better to not be invested at all. Let me explain. Now, obviously, none of us were alive in 1900, but let's say that you were able to put $200 in the market, that S&P 500 index again, for instance, in 1900, and you left that money alone until 2022, last year. In 2022, you'd have over $17 million. However, if you had invested that same $200 in 1900 and you missed just the 30 best months during those 122 years, meaning you did not get the good returns of the 30 best months, you of course would not have $17 million, but would it surprise you, you'd have only $578,000. With this type of information, it's no wonder Wall Street has preached buy and hold as the way to outperform. Now, you might be thinking $17 million sounds pretty good to me. But what I'm here to share with you, however, is the whole story. You see, if you had taken the same $200 from 1900 to 2022, you didn't buy and hold, you didn't miss the best 30 months, but instead, you just missed the 30 worst months, you wouldn't have $17 million. You wouldn't have $578,000. Instead, you'd have more than $45 million. Let's look at the same thing, but over a much shorter time period. Now let's say that you invested $2,000. If you had put $2,000 in the S&P 500 in the year 2000, well, last year, 2022, you'd have an account valued at over $8,000. However, if you had invested that same $2,000 in the year 2000 and you missed just the 10 best months during those 22 years, again, meaning you did not get the good returns of just the 10 best months, you wouldn't have $8,000. You'd instead have just a hair over $4,000. Now, if you had taken the same $2,000 from 2000 to 2022, didn't buy and hold, didn't miss just the best 10 months, but instead you missed just the 10 worst months, well, you wouldn't have $8,000, you wouldn't have $4,000. Instead, you'd have more than $26,000. I think this illustration helps explain Warren Buffett's 2 rules for investing. Rule number 1, don't lose money. Rule number 2, don't forget about rule number 1. Now, you might be thinking, yeah, but is it even possible to miss the worst times in the markets? And the answer is a little bit complicated. What I can say is that it is harder to be in the right place at the right time than it is to avoid being in the wrong place at the wrong time. Let me give you a couple examples. Let's say that you sit down to play poker, and on the very first hand of the game, are the odds of being dealt a royal flush high or low? It's low, right? Did you know that it's actually just 1 in 649,740? To put this into perspective, if you were dealt 20 hands every night over your lifetime, you could expect to get a royal flush 1 time. That's 89 years. Now let's say that you're outside, maybe you're golfing, and you see a lightning storm coming. Are the odds of you being struck by lightning high or low? It's low, right? Because if you see a lightning storm coming, you can just go inside, right? So what's easier, being in the right place at the right time and being dealt a royal flush, or avoiding being in the wrong place at the wrong time and going inside when you see that storm coming? I think you know the answer. Let's do it again. Is it easy to win the lottery? No, right? Otherwise, everyone would do it. But if you're going to build a new home and you don't want your home to flood, should you build it on a floodplain? No, because when it floods, your house would be in the wrong place at the wrong time. So what's easier, winning the lottery or deciding not to build a new home on a floodplain? I believe the same thing about investing. It is harder to pick the next huge stock winner than it is to know when the overall markets are getting ready for a pullback. And that's why sometimes the best offense is a good defense. We watch the markets every day and we monitor a number of different resources to help us identify if it would be wise to sell some or all of the stocks in my account and go to cash, all in order to protect my account value. So that's my process. Instead of trying to pick the next hot stock, we have a strategy for what to invest in, when to make a change, and when to get out of the way. So that's number two. Finally, number three, the three essential ingredients required for all investment success. And again, if even one is missing, failure is guaranteed. So the first ingredient that we need, of course, is an account to put money or capital into. You need something to start with. Also, you need to add to it. So remember, I have my own Contour account where I get unlimited trading for one flat fee. And I put money in it. I started with $25,000 that I put into this account. I'm also adding $100 a month to it. So that's ingredient number one. The next thing that you must have is time, and this is such an important component. In my case, for my unique situation, this is money I plan on leaving alone for a long time, for 30 years. I'm tapping into the principles of time in the market, not timing the market. And then the last ingredient we have to have is a return or an ROI or return on investment. Now, I don't know what my average return will be in the future. I'm going to show you what 12% looks like. Something to know when we look at projections is that it is very rare to hit the average anyway. It's kind of like telling someone who's never been to my state, Minnesota, that the average temperature is 50 degrees. Telling them that would not give them a good idea of what to expect if they were to visit. In the winter, it gets below zero. Summers are beautiful getting into the 80s and 90s. So again, the average is 50, but it's very rare that the temperature is actually 50 degrees. The same thing can be said about investing. Sometimes the markets are up, sometimes they're down, and over time we can determine the average. But it's very rare we actually get the average. I believe that in the future, when we look back, a 12% average return is not out of the question. And if that's the case, then when you do the math, $25,000 today plus $100 a month for 30 years at 12% per year, ending balance is just a little bit over $1 million. This is the magic of compound interest. By me just actually setting aside only $61,000, I'm projecting it to grow over $996,000. Now, the one thing we know is that if you change any one of these components, these three components, you change the end result. Let's say you have $100,000 saved today, and you are adding the same $100 a month that I'm adding, but you only have 20 years. At the same average return, you too would end up with over $1 million. Or maybe you're closer to retirement. Maybe you have $250,000 today. You're in your higher earning years and you're adding $1,000 a month, but you've got just 10 years to grow it. Well, if that sounds more like you, then you'd end up with just over $1 million as well. The amount of money that you have, the amount of time that you can give it to grow, and the return that you get, these things are all unique to you. If you change any one of these three components, you change the end result. Okay, so we just learned these three things: how to avoid the internal expenses of mutual funds and annuities, the weird, almost backwards investing secret, and the three essential ingredients required for all investment success. In other words, we learned to invest in individual stocks, individual companies, get back to the basics of investing. Number two, to have a strategy, a repeatable process for what to buy and when to make a change. This process removes the emotion and replaces it with discipline. And then lastly, I've set money aside and I'm giving it time to grow. So that is how I am working every day to grow my own $25,000 account to $1 million. And my invitation to you today is to follow along on my journey at investlikeeric.com. On a regular basis, I'm posting updates. I'll share the balance on my account. I'll show times when I'm making trades in the account. I'll share performance updates. Maybe the next time we decide to sell everything, go to safety, I'll post an update for that as well. Now, you might be watching this years after I get started, and that's okay. You can go back and watch this journey from the beginning. I'm going to put it all out there. So again, after today's presentation, if you haven't already, I invite you to visit me online at investlikeeric.com, see where I'm at in my journey from 25,000 to $1 million, and absolutely subscribe to my email list so that you can get notified when I post a new update. Now, I promised that if you stayed until the end today, I'd show you how you can easily copy me even if you know little to nothing about investing. And that's really what makes this different. 2023 marks 20 years that I've been helping people invest their money in the stock market. And a simple request that I have received numerous times over the years is, Eric, can you just invest my money the same way that you invest your own? And the answer, yes. I can invest your life savings the same way I'm investing my own money. I'll invest your account in the same 30 stocks that I'm invested in today myself. If I sell any of those stocks, I'll also sell the same ones in your unique account. If I buy new stocks in my account, I'll buy the same new stocks in your account. If I decide to sell everything and go to safety because I think there's a bigger downturn coming, I'll do the same thing in your account. When your account gets billed a fee, I'll bill my account the same fee and I'll give mine to charity. I will invest your life savings the same way I invest my own. Here's how it works. Remember earlier I told you about my unique Contour account, the one that I pay one flat fee for unlimited trading? We can open the same type of an account for you. This is your own separate account. Your money is not combined or commingled with anyone else. You get your own statements, your own tax forms, your own reporting, your own 24/7 online access, and more. And this is where it gets really, really cool. Remember the wide moat strategy that I just explained? Well, anytime Tom and I make changes to the strategy, those same changes are made in each of our accounts at the same time automatically. This means that if the strategy says it's time to sell a particular stock and buy a new one, that stock is sold in both my account and your account at the same time and replaced with the new one in my account and in your account automatically at the same time. So think about all the different types of savings accounts that you have. Whether you have money saved up in an IRA, Roth IRA, maybe you have old 401ks that you left at previous employers. Maybe you have an individual account like I have, or joint taxable accounts. Maybe you have savings held directly with mutual fund companies. There are a lot of ways that this can work for you. You can have your own Contour account for any of these. Maybe you have $25,000 in a Roth IRA. Maybe you have $250,000 in a regular IRA. Perhaps you have several old 401ks out there. My team and I can help you consolidate them and have them invested the same way I'm investing my own money. We have many clients we are doing this for with multi-million-dollar accounts. So if that sounds like you, this can work for you too. But we also work with many people with much smaller amounts saved. If that sounds like you, we want you to know that this can work for you too, and we look forward to the opportunity to show you how. So again, if you have $25,000 or more in a single account, or if you have 250,000, 2.5 million, or $25 million in many different accounts, I will invest your life savings the same way I'm investing my own money. So if you are at all interested in having me do this and having me invest your life savings the same way I'm investing in my own, then here's what happens next. In a minute, I'm going to point you to a pre-qualification survey. The strategy that I use for my own money is not right for everyone, and this is important. I have to abide by a fiduciary standard. Remember, I am a fully licensed and fully regulated financial advisor. Your time is valuable, and I don't want to waste it. So the next thing that you need to do is to take a short online pre-qualification survey. After you take the questionnaire, and if you do pre-qualify, you'll then be taken to a webpage with my calendar on it, and you'll be able to schedule a one-on-one Zoom meeting with me personally. So that's the second step. Now, as soon as you schedule this meeting, you'll be sent a confirmation email with a list of the exact stocks that I'm invested in right now. So if you wanted to know what those 30 stocks are, I'll be able to send it to you as part of that email. Now, at this third step, at this Zoom meeting, our agenda will be to do three things. Number one, answer any questions you have. We covered a lot today, and what I'm offering here is very unique. I have not heard of anyone else doing this, so I'm sure you have questions. Next, we'll discuss your personal situation and come up with a game plan unique to you and your needs. We'll look at any and all of the different kinds of accounts you have. Again, whether you have money in IRAs, Roth IRAs, individual or joint accounts, money held directly with mutual funds, trust accounts. We can help you convert and maybe consolidate old 401k accounts into an IRA. You are unique. There is no one size fits all plan. And then lastly, I'll explain how we actually implement your plan. I'll share with you the process for getting you from where you are now to where you want to be based on your personalized plan. My team and I are here to help you every step of the way, and we want to make any changes as easy and pain-free for you as possible. So with that, head on over to investlikeeric.com, click on that pre-qualification button, take the short questionnaire, see if you qualify, and if you do, grab a spot on my calendar for this short Zoom call. Again, one-on-one with me personally. That concludes today's presentation. Thank you for spending some time with me here today. I hope this presentation helped you see a different way of doing things, and I sincerely hope to see you on my calendar very, very soon. And again, while you're over at investlikeeric.com, be sure to enter in your name and email, subscribe to updates. There are 2 updates on the website right now, a short video showing you me actually investing in those 30 stocks initially. And then I just recently did a first quarter update where I reviewed performance and how the first quarter did. We had a great first quarter. So if you're interested to see how this is performing, be sure to go and watch that update. And again, don't forget to subscribe to my email list so the next time I do an update, you get a little reminder and you can check it out. So with that, again, head on over to investlikeeric.com, click on the see if you qualify button there at the bottom, and hope to see you on the calendar very, very soon. Bye, everybody.